Welcome to an in-depth exploration of corporate venture capital, or CVC. Today, we're uncovering how industry giants strategically invest in external innovation to drive significant growth and stay ahead in a rapidly evolving market. At its core, CVC is direct investment by a corporation into external startup companies. Unlike traditional venture capital, CVC is driven by a dual motivation, not only financial returns, but also crucial strategic objectives. This unique blend makes CVC a powerful tool for large enterprises. So how does CVC differ from traditional venture capital? Traditional VCs are primarily focused on financial returns within a specific time horizon. CVCs, however, often prioritize strategic alignment, gaining insights into new technologies, markets, or talent, even if the financial return takes longer or is secondary to the strategic benefit. Their investment horizon can be much more patient, fostering deeper collaborations. Corporations engage in CVC for a multitude of strategic reasons. These motivations extend far beyond just financial gain and are deeply integrated with long-term business goals. One primary motivation is strategic foresight. CVCs act as radar, detecting emerging technologies and potential disruptors before they become mainstream. They map the innovation ecosystem, understanding where new trends are forming and how they might impact future business lines. This helps corporations stay agile and competitive. CVC provides a direct window into external innovation, serving as a dynamic monitoring system. It allows corporations to identify promising startups that could complement their existing business or become future acquisition targets. This creates an efficient M&A pipeline, reducing the risk and cost of traditional mergers and acquisitions. Beyond just identifying targets, CVC investments often serve as a right of first look into startups for potential future acquisition. This strategy allows the corporate parent to deepen their understanding of a startup's technology, team, and market fit over time, minimizing integration risks before committing to a full acquisition. CVC can be a powerful tool for talent acquisition, allowing corporations to identify and engage with cutting-edge talent within the startup ecosystem. Furthermore, it accelerates digital transformation by providing access to innovative technologies and methodologies that can modernize internal processes and offerings. Through CVC, corporations gain early, hands-on exposure to cutting-edge technologies like advanced AI, robotics, or sustainable materials. This exposure directly influences internal R&D strategies, allowing the parent company to adapt and integrate new capabilities faster than relying solely on internal development. The structure and operation of a CVC can vary significantly, reflecting the diverse strategic goals of their parent corporations. Let's explore the common operating models. CVC units can be structured in various ways within the parent organization, often sitting under corporate development, strategy, or innovation teams. This placement influences their autonomy, agility, and how closely they align with the parent company's day-to-day operations. Two primary models are direct investment, where the corporation invests directly from its balance sheet, and dedicated CVC funds, which operate more like independent VCs with their own management teams and investment mandates, albeit with a corporate parent. CVCs often have specific focuses, whether it's early-stage investments, seed/Series A, or expansion stage rounds. Their geographical strategy can also vary, from focusing on domestic innovation hubs to pursuing global opportunities in emerging markets. Beyond direct investment, corporations also engage in LP investments, acting as limited partners in independent VC funds. Hybrid models combine elements of both, allowing for flexibility and broad market exposure. Investing as a limited partner in independent VCs allows corporations to gain valuable market insights and exposure to a broader range of startups without the operational overhead of running their own direct investment arm. It's a lower commitment way to stay connected to the venture ecosystem. For startups, securing CVC investment comes with unique advantages, often referred to as patient capital and access to invaluable strategic resources that traditional VCs simply cannot provide. One of the most significant benefits is channel access. CVCs can open doors to pilot projects, co-branding opportunities, and even serve as a marquee customer, providing critical validation and accelerating market entry for the startup. This credibility boost can be transformative. The CVC landscape is populated by some of the world's largest and most innovative corporations. Companies like Google, Salesforce Ventures, Intel Capital, and Microsoft's M12 are pioneers, demonstrating how strategic investment can fuel both corporate and startup success globally. Within specific sectors, CVCs have carved out remarkable success stories. GV's impact on tech, Intel Capital in semiconductors, Salesforce Ventures in SaaS, and Reliance Geogen Next in India showcase how targeted CVC can dominate specific industry verticals. While highly beneficial, CVC is not without its challenges and risks, both for the corporate parent and the portfolio startup. A common challenge for startups is the unclear exit intentions of CVCs. Unlike traditional VCs with defined fund life cycles and clear exit strategies, CVCs might have longer horizons or view investments primarily as strategic rather than purely financial. This uncertainty can create friction and misaligned expectations. CVCs often face slower decision-making processes due to internal corporate approvals and complex hierarchies. Furthermore, strategic misalignment can occur if the startup's growth trajectory or market focus diverges from the parent company's evolving strategic priorities, leading to a strained partnership. For startups, being perceived as too reliant on a single corporate investor can limit future partnerships or investments from other VCs who may view the startup as less independent or potentially an acquisition target of the CVC's parent. This can hinder broader ecosystem engagement. Startups can experience corporate drag due to the slower pace and bureaucratic processes of the parent company. Cultural clashes are also common, as the agile, fast-paced startup culture can conflict with the more structured, risk-averse corporate environment, leading to operational friction. Startups often express concerns about sharing sensitive intellectual property or strategic information with a CVC, especially if the parent company has competing business units. Establishing clear governance structures and IP agreements is crucial to mitigate these potential conflicts of interest. CVC has significantly reshaped the private investment landscape, bringing new dynamics and opportunities to the venture ecosystem. A notable trend is the increasing presence of CVCs in emerging markets like India, Southeast Asia, and Latin America. Local corporates are launching CVC arms to tap into burgeoning innovation ecosystems, supporting local startups, and driving regional economic growth. CVC has undeniably increased the overall capital pool available to startups. It has also shifted deal flow, with more hybrid deals involving both traditional VCs and CVCs, creating diverse funding rounds and investment structures. The participation of CVCs often leads to higher startup valuations due to the strategic value they bring beyond just capital. However, this also typically comes with increased diligence expectations and more rigorous performance metrics from the corporate parent. The future outlook for CVC points to continued growth and increasing professionalization. There's a stronger focus on measurable strategic ROI, moving beyond just innovation tourism to truly impactful investments. An emerging trend is the spin-out of CVC arms to operate with greater autonomy, attracting top-tier VC talent who might shy away from traditional corporate structures. These independent-looking CVCs blend the best of both worlds. The success of CVC hinges on deep strategic alignment and effective value creation post-investment. It's not just about the money, it's about the partnership. Crucially, successful CVC partnerships require a strong alignment between the startup's needs and the corporate parent's strategic goals. This involves clear communication and a shared vision for how the investment will drive mutual growth and innovation. Navigating potential conflicts of interest is paramount. Governance structures, such as observer seats versus full board seats for CVC representatives, help mitigate strategy clashes and ensure that both parties' interests are protected while fostering collaboration. CVCs actively help scale their portfolio companies by providing not just capital, but also access to corporate resources like R&D facilities, manufacturing capabilities, and extensive distribution channels. This tangible support is often invaluable for rapid growth. There's a growing trend towards multi-CVC syndicates, where several corporate venture arms co-invest in a single startup. This allows for shared learning, diversified strategic benefits, and distributed risk, fostering a more collaborative CVC ecosystem. In conclusion, corporate venture capital is a powerful and evolving force, driving innovation through its unique dual motivation of financial return and strategic impact. It's a testament to how established giants are leveraging external ingenuity to secure their future. Remember, this content is for educational purposes only, and not financial or investment advice.